for Putin, I think it was an easy decision to unload his treasuries and redeploy the capital. And obviously, one of the places where he's redeploying it is in gold.
Hello there, my friends. Chris Marcus here with you for the Miles Franklin channel on Wednesday, July 25th. And today, very excited to have a special guest, my good friend here in Denver, Dave Kranzler, who runs Investment Research Dynamics, covers the gold markets, the economy, all the exciting and wild things that are happening now. So blessed to have you on here today, Dave, and dig into the markets. How is everything going over there in Denver?
Well, it's still summertime, so everything's great. Don't have to worry about cold weather yet.
Yeah, weather a little better than the U.S. financial position, which obviously you have been covering, as well as the developments in the gold market. And you recently wrote an article mentioning how you're noticing some similarities to what happened in 2008. And if you want to take it from there and give us a general overview of what you're seeing and what we should be looking out for.
I assume you're kind of referring to the trading action in the precious metals,
right.
But also maybe sort of in the background there, what's going on with the economy. Mm-hmm. And I've been making comparisons between the trading action in gold and silver now with the trading action that occurred starting in March of 2008. It is actually toward the end of March. Gold had just hit 1,020 and it had been moving higher rapidly. And I forget the price that silver topped, silver topped. I want to say, I think around 19 bucks an ounce, but I'd have to look. But
and I've 21 before it dipped down to 9, if I remember.
There you go. And I remember the whole thing pretty vividly because I was actually up on a ski vacation in Crested Butte at the end of March, and in the morning before we would go hit the slopes, the steep slopes up there, I would spend a couple hours trading the market. And I remember gold hit maybe even it ticked over 1,020 in like I don't know, I guess it'd be the June contract. And then all of a sudden it started selling off and it kept going downhill. And then I think I want to say July, and again, I'd have to look at a chart to get the timing exactly right. But I remember it was a Sunday afternoon, and I was out in the backyard queuing up the grill, and I walk in and made the mistake of looking to see where silver was trading. And it was down like $4 at the open, and I like jumped on the internet and like contacted some people. I'm like, am I hallucinating? And lo and behold, no, it was the final takedown of gold and silver had been started in July. I think it was July. And that formed the bottom for gold and silver in late October that year. Now, mind you, the takedown of gold and silver began at the end of March, and that was, at the time, there were rumors of Bear Stearns' demise going around.
Right.
And also at that point in time, the housing bubble that we had just been through, that kind of got fomented by Alan Greenspan starting around 2003, that had already crested. The housing stocks had been tanking since mid-2005, and the mortgage market was getting ready to blow up. Housing inventory was soaring, prices were coming down, and this was all happening in the spring of 2008. And you know, the backdrop there is rumors about Bear Stearns' demise. And so logically, it would have made sense that gold and silver should move higher, right?
Mm-hmm.
I mean, that's, you know, contra dollar, flight to safety, financial system may be imperiled. Gold and silver should be going higher. So no, the way that you try to cover up and disconnect the smoke signal, the alarm signal that gold and silver are meant to send, is manipulate them down using paper. And that's what they did. And even after Bear Stearns' collapse, they continued to take gold and silver lower. And then at the time, I had a friend who was still working at Lehman. I think he got bounced in April. And he didn't get bounced because he did anything wrong. He got bounced because their business was collapsing.
Yep.
And, you know, rumors of the Lehman started surfacing. And again, you would have thought, I mean, it was obvious something bad was happening in the financial system. The housing market was in free fall, and things just looked really bad in general for the United States. You would think gold and silver should be going higher. No, they continue to take them lower. So we know how that story played out. Fast forward to now, and we're kind of in the same period. I mean, although a lot of people have their head in the sands on this, or they're in denial, certainly Wall Street and the mainstream financial media is in denial. National Association of Realtors is in denial. But the housing market is heading south, and it's starting to head south pretty quickly. In fact, I'll be posting a blog post a little bit later, and I reference an article on the housing bubble blog, it's called. It was around in the mid-2000s as well. And it featured an article from a realtor in the Northwest, where real estate's been very hot, who said discount prices tend to snowball the selling and snowball prices going lower. And that's what I think we're about to enter into now. Among other things, we're probably going to get a phony GDP print on Friday, you know, so that they can hang it out there as propaganda saying, see, the economy's great. Well, everyone knows the economy's not doing great. Right. The average household's disposable income is declining. Everything is becoming less affordable. And notwithstanding the phony jobs report, there's 102 million people in the working age population that don't have jobs. Right. How on earth can the economy be doing well with that backdrop? It's not. So to me, again, and the takedown in the price in gold and silver is not anywhere near as severe as it was in 2008. But part of that is because I don't think they have the ability to take it down to the extent that they took it down in 2008. And we're seeing all kinds of signs that that's the case. There's stress in the physical market in London. There's stress in the physical market in Hong Kong. In London, LBMA gold forwards are in backwardation. Lease rates are negative. When lease rates go negative, it means central banks are trying to force bullion banks to lease gold, because a negative lease rate means the central bank's paying the bullion bank to lease the gold. So the price action that we're seeing is 100% in the paper market, the paper derivative market. It's not in the physical market. All the data that I monitor and have access to, India has actually been buying more actively in July than they normally do. And China's kind of dormant, but China's always dormant in July. I'm sure you saw it, I'm sure the listeners saw it, there was a seasonality chart for gold that went around a few weeks ago. And I was looking at it, and again, I'd have to look at the data period for which it was calculated. But when I first started in this sector back in 2001, let's just say 2001 through 2008, July was usually not a good month for gold and silver, because India, who was at the time the primary visible buyer, China was buying it. It just wasn't known that China was a huge buyer back then. But India was, you know, they were importing 900 tons a year. And July was one of their lowest import months of the year. It's a seasonal thing. They're kind of in between festival and holiday seasons when you head into June and July and August. And so my memories of gold in July has always been flatten out trading positions, because there's a good chance the price of gold will go lower in July. Right. And when I saw that seasonality chart, I got excited, but then I was like, well, wait a minute. You know, I know right now China's not importing at a huge rate, at least that we know of. And the sentiment in the sector is really bad. So I wouldn't be surprised to see gold and silver get taken even lower. And again, it's contrary to what you would think gold and silver would be doing now, given the fomenting financial and economic turmoil that's brewing in this country. Right. So anyway, that's kind of a long way of explaining why I think the trading action in gold and silver is very similar to the way it was in 2008. And long-term gold and silver investors shouldn't get discouraged right now. In fact, they should have more resolve either to sit tight and be right, or if you've got extra cash, buy some more physical gold and silver, or buy some mining stocks.
Yeah, because while there might not be a lot of people in the US or in the Western states going out getting excited about gold, I found it interesting how you see some big foreign central banks repatriating their gold, whether it's Turkey and Hungary who have gone this year.
Several of them have this year.
Right. So, any thoughts on that? Where, again, it's easy to look at the retail level, but you do have some big customers taking gold, and for people who are buying gold and silver, I like being on that side of the trade rather than the U.S. side of the trade, where the only thing that happens is the debt goes up. And it's amazing how there's not even any talk of doing anything about it, but just piling on more. So, thoughts on being on the side with the foreign central banks that are actually buying and taking possession of their gold?
Well, I mean, I've always felt that you don't own gold or silver unless you actually hold it physically in your hand or have it at least under your own private safekeeping.
Right.
We've heard these reports, and again, to some extent, I take it with a little bit of grain of salt considering the source. But there have been reports that some German and Swiss banks have refused customers gold who came in to get gold that was being stored in those vaults. And on the assumption that those were either 100-ounce or 400-ounce bars, you would have to assume that that gold's been hypothecated, and banks have to go out and repurchase those bars in order to make delivery. So I don't know how that story is going to end, and perhaps the credibility of the story relies on hearing how the story ends up, and I don't know if we will. But I know that there's several analysts out there who like to point to mint sales as an indicator of gold and silver demand, and they extrapolate that out to say this is worldwide global demand is really low. Look at U.S. mint sales, and that's just hogwash, because the U.S. retail buyer is a very, very tiny portion of the physical gold buying and silver buying world. What you need to do is you need to follow the data that's available for gold and silver importation into India. There's not really a good source of silver importation into China, but we can assume, given the massive solar program they have installed over there, that they're using a lot of silver on an annual basis. We can monitor gold going into China via the Hong Kong export numbers to China, but they also have two other ports of importation, Beijing and Shanghai. And I probably still have the article saved somewhere from the South China Daily News, where it said specifically, China opened these ports of importation to make it harder for the rest of the world to see how much gold is going into China. And then I know you wanted to talk about the Russian treasury bond sales.
Yeah.
Well, part of what they've been doing with the proceeds from that is converting it into physical gold.
Right.
So those are your big buyers. Those are the guys. And also Turkey. Turkey's emerged in the last 12 to 18 months as a huge buyer of gold. And the prime minister over there, and who knows what's true, what stories are true about him and what aren't. But I remember he gave a speech to his public. He said, take all your cash and all your dollars and convert it into gold. I mean, he told the world that Turkey was going to be buying a lot more gold, and they imported a record amount in 2017, and they're on track to import even more this year. And again, I get these numbers from it's a subscription gold service called John Brimlow's Gold Jottings. It's geared towards institutional investors. It's kind of expensive, but we get it because it helps us manage our funds. So, and he tracks the entire physical gold buying world, and you get the data on a daily basis. So that's how I know all these numbers about India and China, et cetera, and Turkey, Vietnam.
Yeah, and it's interesting you mentioned Erdogan's comments, and also we've heard similar comments from Putin, where it's not as if they're just going out selling treasuries or buying gold and we don't know why. I mean, they're stating the obvious rather clearly, that they're tired of the way the dollar has been used as a source of power to go around implement some of the foreign policy. which also makes me wonder, you see the coordination between China and Russia, and certainly maybe China's not speaking up about it as much, but again, given what Russia just did, which to me was stunning to see them basically dump their entire treasury position over 2 months, and again, being very vocal about why they're doing it. I'm wondering, do you see the possibility to the standpoint that, you know, if I'm Japan or another country out there that's holding a lot of treasuries, again, given why Russia sold, why there might be incentive for others to sell, you would think maybe that someone's saying, well, maybe I might want to move before the rest of the crowd does. Again, it's still a little bit early, but do you see that as a potential scenario where others notice and more start to pull out of the U.S. Treasury market?
That's an interesting question, because on the one hand, you could say, well, China's holdings were about 10% of what, Russia's holdings were about 10% of what China and Japan hold. And so, you know, I don't know how tightly allied Russia is with Japan, but they're clearly very tightly allied with China. And, you know, you could say, well, maybe they know China is going to start unloading and they wanted to get out of the way because they have small holdings, and there's no reason to be a fly waiting for a bulldozer to run you over. And so maybe they had a heads up from China. I don't think that that's the case, because when I look at China and Japan's holders, it reminds me of the adage of, you know, if you owe the bank $10,000 and you can't pay it back, you're screwed. But if you owe the bank $10 million and can't pay it back, bank's screwed. Well, that's kind of the position China and Japan are in with respect to their treasuries. So, and I mean, to me, shorting the dollar long term is one of the most obvious trades out there. But I wouldn't do it right now because the U.S. is hell-bent on propping up the U.S. system, and they'll do whatever it takes. And I think, unfortunately, ultimately, that's going to end up in a military conflict. But between then and now, I think I've always thought, and this goes back to the early 2000s when I got into this sector and I saw what China was doing. And my feeling was they knew that they owned more treasuries than they could ever possibly sell. And once, let's say they started liquidating, I mean, everyone would know it. And the dealer community would know it well ahead of it being announced to the public, or the rumors being leaked out to the public. Once China started selling en masse, everyone else would rush for the exits at once, and it would drive the treasury market basically to zero. Right. So for them to unload their treasuries right now, it would be sort of like, you know, urinating on their own feet. And I don't think they want to do that. So I think what they've been trying to do is sort of slowly extricate them from the economic consequences of what's going to happen when the dollar collapses in the U.S. I mean, I don't know how the U.S. addresses its debt. It's either got to start printing a lot more money or just default. And maybe, I don't know which path the U.S. will take, but either way, the real value of the treasury paper that you hold in your hand goes to zero or approaches zero, right?
Yeah.
And I think, that writing's been on the wall for a long time.
Yeah.
So, and that's one of my theses on why China has been accumulating so much gold and why they've accumulated a lot more than has been disclosed to the world, is for them, it's a hedge on their treasury position, which is an impossible position for them to liquidate. Right. Now, in terms of how Japan's treating that, I don't know. I don't know what Japan's doing in terms of their sovereign gold position. I certainly haven't read reports about the Japanese government accumulating gold. I know the Japanese public from time to time becomes fairly active in terms of buying gold. But again, that's small fry buying. It doesn't really have an effect on the global supply and demand of gold.
Yeah.
So I think Russia just saw the writing on the wall and said, well, this is an obvious trade. Get out of dollars, sell dollars. And I wouldn't say they're shorting them per se, but it was, for Putin, I think it was an easy decision to unload his treasuries and redeploy the capital. And obviously one of the places where he's redeploying it is in gold.
Right. Which is one of the things that I always liked so much about gold and silver. As soon as I was broken free of my MBA programming and all the other garbage that I learned It's
I
funny,
hear you there.
when people ask me about going to Wharton, I often, and again, I'm not trying to bash that, but just to the degree that that's, where I learned some more Keynesian economics, it's almost like I realize I have to unlearn so much of what I was taught there, what I was taught in Wall Street, because it's just, like you said, part of a system that's trying to maintain itself. And in terms of, like you said, shorting the dollar, to me, just owning gold and silver has always felt like a great way of doing that, where you don't have to take leverage, you don't have to go on margin, and you can just sit there and leave the gold and silver. And unless Trump and Obama and the Clintons and the Bushes have some secret plan to resolve the debt that they haven't sprung on us yet, like you're saying, gold and silver. I would say in my entire financial career, I don't think there's ever been anything that seemed so naturally logical as once I started looking at the numbers, seeing gold and silver as a response. So that makes a lot of sense what you're saying. And something you touched on earlier that I'd like to get
real quickly here. I just have to throw this in there. The interesting triumvirate of Wharton grads: Michael Milken, Donald Trump, Chris Marcus.
Oh boy. Well, I think I actually did see Ivanka in the computer lab one day. So I heard someone on their phones leaving a message from Ivanka, and turned around and there's at least, hopefully I'll change the trend there.
Probably not.
I don't know if there are too many Austrian economists coming from the
Zero.
established, so I'll be a trailblazer. And as you mentioned before, wanted to get back real quick to real estate on behalf of my friend Melissa, who's here in Denver, and I think this represents a similar question that people who aren't yet reading Investment Research Dynamics, which, by the way, you do cover these in the Miners Journal and also the Short Sellers Journal. So it's nice that you give a perspective of both things people can get long with gold and silver, and also some of the things they want to short. And my friend Melissa is considering buying a house right now. And certainly, I think for people who aren't digging in as much, it's a tricky dynamic. They've seen home prices go nuts. There's the fear of missing out. If I don't buy it today, will it be $100,000 higher tomorrow? What would you say to someone that, again, is in that position, and based on everything that you're seeing, what advice would you offer to someone in that situation?
Sure. Well, I think the higher price next week than today's ship has already sailed, and I think it sailed in just about every market around the country. And I'm going to be talking about this in my next Short Sellers Journal, which I've covered the housing market extensively, and my subscribers and I have done really well with home builder puts and shorting home builders since the beginning of the year, and we'll continue to do well with it. I mean, buying a home is a tricky thing, because for a lot of people, it's a place to live, and that's the way it should be treated. It shouldn't be treated as an investment. So if you're worried about the price of the house going up or down, then you probably don't want to buy a house right now, because I can tell you right now, and I will guarantee this, prices are going lower. Maybe not right away, but they are going lower. They've already rolled over in Denver, and the outer burbs. In fact, I was just discussing this yesterday with a subscriber who's a local realtor out in the west side of Metro Denver. And she said it's still, the inventory is a little bit tight still in the under $600,000 price bucket. And I added to that, yeah, but that'll change. and she knows it. And in the over $600,000 price bucket, I mean, prices are really starting to soften up. There was an article in the Denver Post in early June that was talking about how inventory is now coming on the market in Denver. And I use Denver as an example because it was a top 10 hot market over the last 3 or 4 years.
Oh, yeah.
And it was the same thing in the mid-2000s housing bubble. Denver was super hot, and then it was one of the first ones to go bust. So Denver is, and to some extent, in some areas of economics, it's a demographic bellwether. So this article was talking about how inventory in Denver is coming on the market at a 25% greater rate than contracts were being signed, and that was from early June. And just from anecdotally driving all around central Denver, which is where I live, and I do that a lot, and I used to do it in the mid-2000s because it would tell me what's really going on in the market. I don't want to hear about it from real estate pimps like the National Association of Realtors, or from mortgage brokers and real estate brokers who have a vested interest in the price of housing always going higher and the supply declining to
so you're not on the edge of your seat waiting from the latest report from the Bureau of Labor Statistics.
No, I'm not. In fact, I usually sleep through that, and I read about it a couple hours later. So, but at any rate, and this is just in the last couple of weeks, I've been kind of stunned at the number for sale signs I'm seeing pop up.
Yeah.
And this subscriber of mine who lives on the west side sent me an article from Westward, which is the local rag, and she prefaced it with, they don't study the NAR or the Census Bureau data, so they're not tainted in terms of the color they have on the housing market. And it was an article that featured the top 10 neighborhoods in Denver where rents are falling. Mm-hmm. And I agree with her in this. She said she always uses rents as a bellwether for the direction of the housing market. And that's exactly what happened in the mid-2000s bubble. So, and Manhattan, the same thing's happening. New York City was one of the areas where the first, or not the first bubble, but the mid-2000s bubble started showing big cracks. New York City, Northern and Southern California. There was an article that I'm writing about right now that was out from the California Association of Realtors, and I'm surprised they were this candid. In June, sales were down a little bit over 7% year over year, and inventory's up 8%. So, and I get reports. One of the benefits of writing these journals is I get reports from all over the country from subscribers about what goes on in their market, and I want to hear about what's going on the ground. I don't want to hear about what Larry Yoon, chief economist of the National Association of Realtors, what type of spin he wants to put on the horrible numbers coming out. So, and we're seeing, existing home sales have been declining now several months in a row. New home sales, who knows, because the numbers are Census Bureau manipulates the numbers so much. I was actually quite surprised at how large the drop in new home sales was, because I figured Trump would want him to paint a better picture for the housing market. So, and maybe he doesn't. Maybe he left it alone because obviously he wants lower rates. I think we're at a point now where even if they took rates lower, it's not going to fix the problem. It's not going to divert what's happening in the housing market, because the government, through its mortgage programs, has essentially created what would have been considered a subprime mortgage product in the mid-2000s, and a 0 to 3% down payment mortgage with a 50% debt to income ratio, meaning on a pre-tax basis, up to 50% of your income can be used for debt service, including your mortgage. That's insane. That's pre-tax, by the way. And in a lot of cases, no income restriction. That's a subprime credit profile. And to me, it tells me that the pool of potential home buyers who can potentially qualify for a conforming government-sponsored mortgage is shrinking considerably. So therefore, the demand for housing is shrinking. And that's what's going on in the housing market right now. Demand side shrinking, affordability, part of it's affordability, and part of it is not being able to qualify for a mortgage.
Yeah, and one of the things you touched on earlier is that, you have an underlying economy that isn't as strong, and the government in particular often likes to say, well, we need to keep housing prices high, all the effort that was put into propping up the market. Yet, that's great if you have a house, but for all the people who might be entering the market, especially with wages and incomes not really skyrocketing, when the price of the house is skyrocketing, that's not good for those folks, like you point out. So it sounds like you're saying that certainly, obviously it's specific to each person, but if someone were interested in buying a house, certainly you wouldn't see any rush to get out there, because especially with interest rates rising, which to me has always loomed as one of the most likely triggers to pop some of these bubbles. Certainly that time is on your side, and if you have the ability to wait on purchasing, there's a good chance that in the next couple of years you could get the same property for a lot less.
Well, I would just say to your friend Melissa, look, if you don't care about the value of your house and you just want a house that you can say is yours, even though it's really the bank's, place to keep your stuff long term, you're tired of moving, then go buy a house. But if you wait, I can guarantee you next year around this time, you're going to be able to get a better house for less money. So if it were me, I'd just rent for another year.
Yeah, especially having capital freed up that could be allocated to precious metals when they're at the cost.
Your friend Melissa's a gold buyer.
Well, I'm working on that one. She's been watching some of the interviews and articles, and again, that's why I appreciate you being on here, because for me, especially growing up, kind of believing in the system, and then after the housing bubble collapsed last time, seeing the other perspective, because I started listening to folks like you and the other Austrian economists that are not put on the mainstream. So these are things that people can understand. They don't have to feel overwhelmed, and there are solutions out there, which I think is great. And again, that's why it's nice to have you on here today. And if you could just, before we wrap up here, let folks know where they can find you, some of the services you offer, and if you have any parting thoughts. Again, as always, great content you've shared with us. And how can people find Dave Kranzler here in Denver at Investment Research Dynamics?
Well, maybe they don't want to find me. Some people call me Nostradamus.
Yeah.
Well, thanks for having me on again, Chris. This is a great podcast that you've developed, and I enjoy being a guest on here, and I appreciate you thinking I have the level of wisdom required to become a guest. But my blog is Investment Research Dynamics, and I publish the Short Sellers Journal and the Mining Stock Journal. Mining Stock Journal is bi-weekly. I send it out twice a month on Thursday evenings. And the Short Sellers Journal is weekly. That gets sent out on Sunday afternoons, and I actually have a fairly active subscriber base who, we talk about trading ideas via email almost on a daily basis. And in terms of shorting the market, I offer a lot of different ideas in terms of how to do it without actually shorting shares. And as I've said, my subscriber base and I have done very well this year shorting the home builder sector. And I expect that gold mine has a lot more gold in it to mine. So that's where you can find my stuff.
Yeah, and they're great reports. As you know, I signed up and I'm a subscriber now. And when I think of what you've seen, the experience you have, and that, I talk a lot about the more macro things, but for folks who really are interested in trading and having some great ideas, you present a lot of good information, and it's interesting seeing a lot of the ones you're right on. And also that you put the right perspective on it, where it's not saying this is definitely going up, but factoring in probability, which is what the science of trading is. So I highly recommend those. I've been enjoying reading them. And again, Dave also has a free newsletter that you can get on if you'd like to sample some of the ideas first. And it's just been great following your work, and I appreciate what you're doing, explaining a lot of these issues that get complex, but letting people know there are ways to respond out there, and you don't have to be panicked and nervous. But when you understand and see how it goes from the inside, which Dave has seen and shares now. So again, thank you so much for being on the show. I hope we're going to get to catch up for lunch soon. Maybe head over to Jerusalem And again, visit Dave at Investment Research Dynamics, and we will talk to you soon, my friend.
Thanks, Chris.